everyone. Welcome back to another episode of Retirement Redefined. I'm your host, Brad Gatto, and normally I've got my co-host, Carly Carlson, with me today. If you're watching the video of this, you know that's not Carly. And now if you're listening, you know that's not Carly. I actually have a guest with me today that I get to talk to every single month in a different format through our monthly market commentary. The Chief Investment Officer of Orion Town Square, Tim Holland, is actually in town from Pennsylvania in the office today. So, Tim, thanks for joining us for the podcast, man.
Yeah, no, this is neat. Good to be with you guys. Good to be in the great state of Minnesota. Appreciate the invite.
Yeah, well, it's great to be. It's pouring rain right now. Yeah. It was hot as all get out yesterday. Can't walk around outside. And then today it's pouring. So, but you joined us for an event last night, and that was amazing. And so, what I want to do with this episode, Tim, is tap into the knowledge that you have, because we don't get you all day every day. And so when I have you, I want our listeners to be able to benefit from what you do all day, every day. And specifically what I want to talk about in our episode today, Tim, is I want to make sure I get this right. The one big, beautiful bill. Act.
Yeah. I think, not to get in the politics of it all, I think Chuck Schumer, the Senate minority leader from the great state of New York, stuck act on the end of it just to kind of needle Donald Trump a little bit, because I think he wanted it not to end at the one big, beautiful bill. He wanted act on there because it just doesn't flow as well. Couldn't keep it from being passed by the Senate, but I think it's officially the act. You're right.
So there it is. I'm just going to call it the bill from now, because I'm definitely not going to say the one big beautiful bill act for the rest of this episode. But that is the topic for today, is just talking a little bit through what's in the bill, how does it affect the average consumer specifically, how does it from a financial planning perspective and the families that we serve here at Fiat. And then what I want to end the episode with, Tim, is just talking through a little bit about some of the negative narratives that are coming out of the bill. Primarily this concern around adding to the debt, inflation, devaluing of the dollar, that kind of stuff. And so everybody, thank you for being here with us. I'm just going to dive right in. Okay. And so that everybody knows who you are, if you're not a regular listener to our monthly market commentary, I obviously said that you're the Chief Investment Officer for Town Square Orion, our partner on the investment side of things. But tell us a little bit about yourself, if you wouldn't mind. Like, I know I mentioned Pennsylvania. Where do you live? A little bit about your family, and how in the world you ended up as the Chief Investment Officer of a company like Orion.
Happy to. So my family, Meredith, my wife, our kids, Grace and Spencer, we live in Wayne, Pennsylvania, outside of Philadelphia, about 30 minutes west of Philadelphia, born and raised in the great state of New Jersey, but have lived in Pennsylvania for a bit now. I've been in our business for about 25 years, have worked at hedge funds and mutual fund complexes and the like before joining a company called Brinker, which was acquired by Orion about, 5 years ago.
It's been 5 years already.
5 years. Yeah. Wow. 5 years this September. Calendar pages flip, especially as you get older. So I've been in financial services for 25 years, but before getting into this business in 2000, I worked in corporate public relations for 7 years for capital markets companies like Neuberger Berman, the American Stock Exchange.
I don't know that I knew that, actually.
Barclays Bank. So I've been paying attention to the markets really for north of 30 years now. And before getting into public relations in New York City, I worked in New York City politics for a couple of years. So it kind of took a circuitous route to capital markets and investing in finance and what we all do every day. But I've always been deeply interested in politics and policy. So things like the One Big Beautiful Bill Act or the bill, obviously meaningful for the markets and the economy, but also something of great interest to me from a sort of policy, making of the sausage perspective. And our team at Orion, counting myself, is approximately 30 people. Really smart group of folks, a lot of holders of something known as the Chartered Financial Analyst designation, CFA, CFP, and we get to work with advisors like the team here at Fiat around asset allocation, portfolio construction, manager due diligence, manager selection, and it's just something we really enjoy doing. And we only work with, through, and for financial advisors at Orion because we all have a deep, deep appreciation of the value that teams like Fiat create in their clients' lives. So that's kind of how I got here. That and a Delta flight from Philly to MSP.
how should I put this? If you know the Fiat team really well, you would know we also have a direct employee, a Fiat direct employee that's out in the eastern side of PA that flies via most of the time Philly to Minneapolis when he comes into town about 3-4 times a year, and had a lot of problems with that Philly airport.
Yeah.
So the fact that you're here and you're,
Yeah.
it's pretty good.
Yeah, no, good to be here.
Okay, so let's dive into this bill. There's a lot there. It's like, what, 900 pages?
Just about, yeah.
Something like that. So we're obviously not going to go through the entire thing. And there's kind of big kind of chunks of, like if you look at it from the 50,000 foot view, there's a lot of stuff that's specific to business owners. There's stuff specific to social welfare programs like Medicaid.
Yep.
And then there's major tax legislation in there as well. That's where I want to spend the majority of the time because that's going to affect the majority of the listeners more than anything. And really, I think the way this started off, and maybe you can give us a little bit of the backstory, because of course, the current administration, the Trump administration, kind of ran on this idea. One of the promises that was made that he was going to take the Tax Cuts and Jobs Act, that was the big bill, if you will, from his first term, and extend it out.
Yep.
And so if you are unfamiliar, before we get into this particular bill, the Tax Cuts and Jobs Act, again, same thing. There was like a lot of stuff for business owners, corporations, and things like that in there. But for us, day to day, on the whole, not for every American, but on the whole, it made taxes cheaper.
Yep.
Period. But it had the majority of the line items that changed had an expiration date. That expiration date was the end of this year.
Correct.
And so a lot of what he had done in his first term was going to revert back or go away or expire, sunset, however you want to put it, at the end of this year. And so one of the things he ran on was this idea that he was going to take that Tax Cuts and Jobs Act and extend it out. And so to me, that's kind of the backbone of this big, beautiful bill. Can you talk to me a little bit about that, shed some more light on it, and I guess maybe even give your opinion and disagree with me if you do.
Well, we're sitting pretty close to each other, so I'm probably not going to disagree with you because you're younger and stronger than me, and I'm afraid to catch an elbow.
Younger is true.
Younger, stronger, catch an elbow in the ribs. So the one thing I would say about the bill is, whatever you read about it, maybe just take everything you read with a grain of salt, because one side of the aisle is going to say this is the greatest thing of all time, and the other side is going to tell you this is a disaster, right, in the making for the economy and the American consumer. There's the legislation itself, which is now signed into law, and there's also the reporting around it. So I'm just a big believer in, no matter what your source of information is, always kind of catch my breath and read it and interpret it, but also realize that either that journalist or that pundit may have a particular point of view. We just kind of do. That said, I think, at the center of the legislation, the centerpiece of the bill is the extension of the 2017 tax cuts, right? That came about in the 2017 Tax Cut and Jobs Act. To your point, they were going to expire year end. They're now permanent. Now they're permanent until an administration
until they're not
comes in and decides to do something differently.
Do you remember when Congress, so at the end of Reagan's second term, so this would have been 1988.
Yeah.
He had, he comes into office, and this isn't a political, I'm not telling you I'm a Reagan guy or not a Reagan guy, but he comes into office, top tax rate 70%. By the end of his second administration, or second term rather, it was 28%.
Yeah.
And Congress promised us at that point in time they would never have to raise it above 28% ever again.
Yeah.
So to your point, it's permanent until it's not.
So take everything with a grain of salt, including.
But there isn't an automatic sunset that's just sitting out there.
Yeah. So
right?
so those rates were going to revert to the sort of pre-2017 levels at the end of the year. That's now not going to happen. Depending on who you talk to, that kept a $4 trillion tax increase from going into effect. Now, if you talk to people about the tax code, and we were talking about this last night at the event, which was fantastic. It influences behavior, right? And so now, what's the optimal tax rate? What's fair? What's unfair? We have a progressive tax code, but again, some folks think rates should be higher. Some folks think rates should be lower. Some folks think, we should have one flat rate. But folks on either side of the aisle would admit that tax codes and tax rates influence behavior. If you tax everything at 100%, I'm not sure anyone's going to show up to work because it's all going to go away. If you tax everything at sort of 0 or 1%, the government doesn't have any revenue. So the magic number is somewhere in between.
So because this just came to my head too, and it's another Reagan thing. Like, so prior to when Reagan was working
Yeah.
in his day job, prior to getting into politics, he was an actor.
Yeah.
And at the height of his acting career, the top marginal tax rate was 91%.
That sounds right.
And so his whole thing was, I would make 2 movies a year and then I would stop working because that third movie would put me into that 91% top marginal rate. So when you talk about taxes incentivizing behavior, you've got, that's the extreme example, plus an example that everybody knows who Ronald Reagan is.
Yeah.
Well, at least everybody who's listening to this podcast knows who. My boys may not know who Ronald Reagan is.
Yeah.
But influencing behavior in such a way that he would just literally stop working because he didn't want to give away 91% of what he made. So yes, how they choose to tax us tends to incentivize behavior. Now today, I would argue, so like in the state of Minnesota, as an example, we have the Mall of America.
Yep.
And because we have the Mall of America, things like clothes and other goods like that, there's no state tax on those.
Okay. I didn't know that.
Like, so you don't pay sales tax, not state tax. You don't pay sales tax.
Okay.
And I think, don't quote me on this, I think they did that to incentivize people to come to the mall. Because not only do you get to go to the quote unquote largest mall in America as a touristy type thing, but when you come here, you also pay no sales tax on the items that you're buying in the mall. So again, incentivizing behavior.
Yeah.
How you tax is going to incentivize behavior. So sorry for cutting you off.
No. So if you go back to 2017 and you saw a meaningful reduction, again, fair, unfair, wise or unwise in tax rates, the idea is incremental money went into people's pocket. They're going to spend it. They're going to invest it. You're really going to influence behavior. With the extension of those tax cuts, permanent, at least for now, some folks think you won't get as much of a economic boost because it's just a continuation of what was. But at the same time, if you are sort of taking off the table a multi-trillion-dollar tax hike, you're still leaving more money in people's pockets. So it's probably, from a consumption point of view and a sentiment point of view, a good thing. And it also, at least for now, creates certainty that the tax code is what the tax code is. And folks can sort of incorporate that into their own thinking around financial planning, what they spend, what they don't spend. And obviously companies have greater clarity and certainty as well. And so it's something we've talked about all the time. It's a cliche, but markets hate uncertainty. And the passage of the One Big Beautiful Bill Act and President Trump signing it takes, again, a potential significant tax hike off the table, but just creates tremendous policy certainty, at least from a fiscal point of view, at a point in time when we still have meaningful uncertainty around trade and tariffs. Monetary policy, that outlook is somewhat uncertain. Will the Fed cut rates this year? Will they not? And then you just continue to have a geopolitical backdrop, U.S., China, Ukraine, Russia, Middle East, that's uncertain. So I think the market would gladly take as much certainty as it can get. Mm-hmm. And right now, I think it's got meaningful certainty on the fiscal policy end of things, which is super important.
Yeah, absolutely. Now, the extension of like the lower, each bracket, not each bracket, but like the 12% not going to 15, the 22 not going to 25. Like that's one of the big things. The standard deduction remaining as high as it's been. There's some positives, some negatives that came out of the Tax Cuts and Jobs Act, relatively speaking, for some people, like the SALT deduction. In certain ways you can write things off, but there was some changes too. So it wasn't just take exactly what was in 2017 and extend that forward. And so I want to talk a little bit about some of those changes that came about. One of them was that standard deduction. It was already really high. So to give some perspective, like prior to the Tax Cuts and Jobs Act, the standard deduction for a married couple was $6,000.
Okay.
And so what that means, if you're unfamiliar, is the first $6,000 of income you got to write off, essentially not pay tax on. The second they passed the Tax Cuts and Jobs Act in 2017, live in 18, it went to 12. And then it just kept increasing based on, not 6,000. It was 6,000 per person. I just want to make sure that I get that right because somebody's going to catch me on that and email me. It was 6,000 per person. So if you're single filer, it was 6. If you're married, it was 12. Then it doubled overnight. So, and then they put some inflation adjustments on it. And so this year, it was supposed to be $30,000 for a married couple. $15,000 per spouse is where it has gotten to. Okay. Now it's going to be $31,500. And so the first $31,500 is a married couple. It's half of that if you're a single filer. You don't have to pay tax on. You don't hit the grid, so to speak. The grid starts at 10. Don't hit the grid until we're past $31,500. So that's a change. The second thing, the other big thing in here is if you're over the age of 65, you used to get an additional deduction. That was always true, and that still remains true. That additional deduction was $1,500 per spouse over the age of 65 if you're married. I think $1,850. If you're single, they've added to that. They didn't take that away. That still exists, but there's an additional deduction for being over the age of 65. If you're single, it's an extra $6,000. If you're married, it's $12,000. And so that's a lot of money.
It is a lot of money. And I think that deduction in particular, if you think back to the campaign of last year before Donald Trump defeated Kamala Harris, there was, we're going to extend the 2017 Tax Cut and Jobs Act, but we're also going to go to no tax on tips, which I think he unveiled in Las Vegas, which makes sense given the hotel and convention industry there, no tax on overtime, and then no tax on Social Security. I think the way Social Security is structured and the tax code is structured, they couldn't do no tax on Social Security. So that $6,000 additional deduction for folks 65 and older was meant to sort of check off that box in an indirect way.
Just getting to it a different way.
In a different way.
Yeah.
And then obviously no taxes on overtime and tips up to a certain, up to a certain income level and at a certain amount. So one would argue in my reading of the bill, that's not completely comprehensive, but they checked off those boxes as well. And so that's incremental. And, as we've got a consumption-driven economy, 70% or so of GDP is consumption-driven. And, if you're wealthy, if you have sort of passive sources of income, maybe at the margins, this doesn't mean much in terms of behavioral change. If you're not living paycheck to paycheck, but if you're consuming or spending most of what you're taking home week to week or month to month, those numbers are meaningful, and those dollars are going to get spent.
Yeah,
they just are. So again, back to influencing consumer behavior or sort of the behavior of the average American. Again, the wealthy, probably it's not going to move the needle. Most folks, this will, I think, impact what their lives look like on a day-to-day basis and free up additional money for them to spend.
And since we paused here, before I get to the other couple of changes I think worth noting, I'll just add, this is also relative to your adjusted gross income. There's a phase out, in other words. So this additional $6,000 per spouse over the age of 65 isn't into perpetuity. Yeah. If your AGI is too high, your adjusted gross income on your taxes, they will phase you out of this and you will lose it. And so it's not meant for I would even argue, the upper middle class or the wealthy. Yeah. It's meant for kind of that middle class, lower middle class, low income type families to get an additional deduction, which in essence is more of your income is just not taxed. Yeah. That's all that means at all. Yeah. Before you hit the grid, so to speak, you just get a bunch more income coming in the doors. A married couple, an extra $12,000. I mean, that's a lot.
That's a lot of money.
It's a big deal.
Yep.
So there's that. We can talk if you have questions on any of these things. By the way, as a listener, feel free to call the office because I don't want to get it so far into the weeds that it just gets really technical. Yeah. But the other two changes I wanted to bring up are one, the state and local income tax deduction, or SALT deduction for short. Yeah. In the state of Minnesota, Tim, we pay a little bit of tax. I know you're from Pennsylvania. I don't know what the top tax rate is in Pennsylvania.
I think based on our conversation last night, I think we're pretty close to where you guys are, sort of high single digits.
Yeah. So we're at our top tax rate's 9.85, just below 10. That just reminds me of when you go get gas and it's like a $299.99. It's it's $3. Our tax rate's 10%, 9.85. It's 10%.
Let's call it what it is.
Exactly. So that being said, the SALT deduction, they capped. You used to be able to write off, prior to the Tax Cuts and Jobs Act, all of your property taxes on your federal tax return, the money that you paid to your property for your, to your county for property taxes, to your state, you got to write that off. And then you got to write off all the money that you used to pay your state's tax. Yep. So you didn't have to also pay tax on that money on a federal level. Well, then they capped it at $10,000. And in the state of Minnesota, it was pretty simple to hit $10,000 between those two numbers, between my property taxes and my state taxes. Okay. They've now increased it, back into unlimited, but now it's up to $40,000. But same thing there. Yeah. There's income limits. Yeah. And so you will phase out of that. They're much higher than the age 65 additional deduction. Age 65 deduction, single filer, it's $75,000. Married, it's $150,000 is where you start phasing out. Or lose it rather. Yeah. SALT deduction starts to phase out at $250,000 for a single person, and $500,000 for a married couple. What I will say with these two kind of phase outs, and this is what we talked about a little bit last night, Tim, was this just makes planning more complicated.
Yep, for sure.
When you're trying to, because the language I like to use, Tim, is as you're trying to weave yourself through the tax code as a family and find the most efficient way. The picture I get in my head is like the maze in the newspaper, or like, you got to draw with your pen and you're like trying to find your way through it, and you hit a dead end, you go back, and hit a dead end, and you go back. There is an efficient way for you to get through that maze without hitting any of the dead ends. There's a just right way to do it. And that's what every family is trying to find in the tax code, is how in the world do I get through here to get out the other side and pay what I'm supposed to pay for taxes, but not a dime more. How do I not overpay? Adding these additional income tripwires in for these incentives just adds more complexity. And so from a planning perspective, I will have you know, if you're a family of Fiat that works with us already, we're all over this. Like, we've already started updating our modeling, already updating all of our numbers, and it will change for some of the family, not everyone, but some of the families we work with, it will change the type of recommendations we're making relative to your taxes in retirement. So know that. The last one I want to bring up is the federal death tax exemptions. They're called estate taxes. I call them death taxes because it's a simpler understanding, I think, for people. It wasn't high enough. It was at 13.99 million per person. It's now at 15. What does that mean? As a single person, 15 million, married couple, 30 million. If your estate is worth less than that at your death, they will not hit you with a death tax. Anything above that level, and then you will start to pay death taxes. If you're unfamiliar with estate taxes, or death taxes, as I like to call them, they get really expensive really quick. But you got to have over a $15 or $30 million estate for that to be an issue. Which, if you do and you're not working with us, we should talk because there's just a lot there. So I don't think that one's as meaningful for a lot of people, but it is interesting because the death tax has been, depending on which election cycle you're talking about and which candidate that's running for president, I feel like every candidate had a different opinion of what the death tax exemption should be. And I also feel like, from a policy level standpoint, you know this stuff way better than I do. That's an easy box to check or change or go after. And the narrative plays well. Because all we're doing is just taxing super rich people. Like, if you got a 30, nobody's going to feel bad for the person with $30 million estate if they have to pay more in tax. That's going to play well from a political standpoint. So the fact that it didn't go backwards and it actually went forwards is interesting to me.
No, I think if you think about the U.S. and our history of these 250 some odd years, and the idea of breaking away from England and the aristocracy, we've always had this kind of love-hate relationship, I think, with wealth and entrepreneurs. We're the richest country in the world. We're the richest country the world's ever seen. We've got the biggest economy the world's ever seen. And we were talking about this last night. At least as of now, 18 of the world's 20 largest public companies are based in the United States. And so we have this wealth creating machine, but we still have kind of a love-hate relationship with it. And, the ideas of inherited wealth. And if you go back and read what Jefferson wrote about stuff like that, and is it a good thing? Is it a bad thing? And what does that do to entrepreneurship in the next generation, And then other folks will say, well, you didn't make that money, and why can't Mr. and Mrs. Smith sort of bequeath it to their children or their grandchildren? And then, I think folks who have tried to move the estate tax minimum up, and they've done successfully over the years, I think politically, and they're smart to do this, they've made it about small businesses, the farmer who's owned his land for, here in the great state of Minnesota, land that's been in the family for 40, 50, 60, 80 years, and the kids don't want to farm, right? They want to sort of create a liquidity event, but what do you do with that? So you're right, considering how contentious that issue can be. And again, this sort of, I think, love-hate relationship we have with wealth in this country, the fact that they were able to bump it up is meaningful. And the same thing with salt, getting that to $40,000. The fact that they were able to do what they did to salt in 2017 is remarkable, because the Republicans, have had pretty slim majorities in both the House and Senate. And a lot of those Republicans that voted in 2017 to kind of do what they did with salt then, and then voted to kind of move it back to 40,000 are from New Jersey, are from Westchester, are from parts of the country that aren't necessarily deep red, easy sort of districts to win come next year's midterm election. So I think Speaker Johnson, Majority Leader Thune, the fact that they were able to get all this into one big beautiful bill, even if maybe half the country doesn't think of it that way, is pretty remarkable, considering the majorities that they hold in the House and Senate. I mean, I think it was a bit of again, agree or disagree with the outcome, a bit of a masterclass in how to pass legislation.
Tim, are you trying to say that there's politics involved with what's in this bill
It's
or
like,
any bill
it's
for
like
that matter.
Casablanca. I'm shocked that there's gambling going on in here for those of you who are Casablanca fans.
Boy, that's a pull.
Yeah.
You're showing your age there.
I'm old. I love that movie. It's a wonderful Humphrey Bogart, Ingrid Bergman.
Isn't that when did that is that the 30s?
40s. So
40s.
it came out. Now, if I'm wrong about this, I apologize. So that movie, I think, was released the summer of 1940 or 41. Like the European War started when
1942. I just looked it up.
Okay, so right after, I guess, right after the Japanese bombed Pearl Harbor. So we were already in it. But yeah, no, wonderful movie. I think
That's a great rabbit trail we just went down. I like that kind of stuff. So I want to spend the rest of the time doing this because there's a lot there. Here's what I want you to take away as a listener. That again, if you're a current client, you should just know we're on top of this, and it is going to change planning and the way that we deal with your taxes. If you're not a current client of our firm and you're not paying attention to this, you should be, because it is just in the little bit of time we've had, Tim, to this point, to kind of start modeling different things out and seeing how it affects the type of planning and the decisions we're going to make on behalf of our families. I will just tell you that on the whole, not for every case, not for every client, it is changing things.
I bet it's got to be huge. I mean, Warren Buffett likes to joke that his favorite holding period is forever because he doesn't want to pay taxes. And it's not what you make, it's what you keep. At the risk of just making it all about the bottom line, it's not what you make, it's not what you earn, it's what you keep.
Yeah.
And I imagine the implications of this, and you understand the planning world a million times better than I do, are just huge.
Yeah,
it's just huge.
It's just super important. Whether you like the legislation or hate it, it doesn't matter. It's in play.
Yep.
It's been passed. It is what it is, and so now we just have to figure out how to deal with it and plan around it the best we possibly can. So, what I want to finish our episode with, though, Tim, is just talking through you talked a little bit about how everybody's going to have an opinion, right?
Yeah.
And so be careful where you're getting your information from. Take everything with a grain of salt. I love that advice. We talk about that all the time, but there is a concern, obviously, because tax cuts sound great.
Yeah.
On one hand, because it means I pay less in tax at a household level. But at the end of the day, we've got bills to pay as a country.
Yeah.
And so there's concern that this is going to cost money over the next decade. I think the CBO estimated this is going to add another 1.4 trillion. Am I?
Anywhere from 1 to 3 and change. It depends on how you define the jumping off point. And I could be getting this wrong. So that's the other thing. I would take that with a grain of salt. Like some folks, I'll sort of back up a little bit.
What's the difference between 1 and 3 trillion? Who knows? I mean, it's like
between
a couple dollars.
friends.
Yeah, exactly.
A couple $1 trillion between friends. Back to the idea that taxes influence behavior. Art Laffer is a famous economist, came up with the Laffer curve, which is the idea is like, this is the number where you optimize tax revenues and you don't at the same time, don't disincentivize entrepreneurial activity. I can't remember the exact number, but he has one at the federal level. So some folks on one side of the aisle will say by cutting taxes or keeping taxes low, you're incenting consumption and spending and investment, and the economy will grow faster, and tax cuts to a certain extent will pay for themselves because greater growth will throw off incremental tax repeats. Sure. Other folks would kind of call that voodoo economics, which is, Reaganomics, sort of that a derisory term for that kind of approach. So I think the Trump administration would say we're going to spur investment and growth, and tax receipts will be better than expected, and the deficit impact won't be as great as projected. The CBO, to your point, is saying it's probably going to be somewhere around $3 trillion over 10 years. But that also works off the assumption, I believe, that the 2017 tax cuts weren't going to be permanent. Mm-hmm. And so the jumping off point matters. If you kind of think about, if I'm remembering this correctly, the 2017 tax cuts as being permanent, the impact is about $1 trillion and change. If you kind of assume there was a reversion and then you kind of cut taxes again, it's $3 trillion and change. So the numbers are huge. They're somewhat unfathomable, but most folks seem to think somewhere between 1 to 3 trillion added to the deficit because of the one big.
Are you trying to say, Tim, that everybody from politicians to reporters and everybody in between would pick different jumping off points to create a narrative that fits what they want?
Imagine.
They wouldn't do that, would they?
Imagine that.
Gosh, that's funny. I didn't know that. Well, I did know that they do that. I just didn't know specifically those numbers are predicated upon where you're starting from. Yeah. Are you starting from this expired or didn't expire? But so All that to say
Yeah.
this, right? The concern, of course, being if we add more to the debt, which is already a massive concern for some people,
Yeah.
that it has all these possible fallouts or tentacles that can cause problems. It could be inflationary. It can be
Yeah.
the devaluing of the dollar, the status of our reserve currency, all these things. And so can we just take a couple of minutes here at the end to talk through kind of the Chicken Little scenario
Yeah.
and if we actually need to be Chicken Little or if there's actually any sort of optimism here relative to kind of where we stand in spite of our debt?
Yeah. So I would define or describe the Chicken Little scenario as, to your point, we're somewhere at 35, 36 trillion in debt. What we've put on our nation's balance sheet. We're running pretty meaningful annual deficits still, and now we're going to add 1 to 3 trillion in debt on top of what already exists. And so, if supply demand determines price, well, we're going to need to create more dollars and more bonds to borrow the money to spend that we don't have on hand. And so, by issuing more bonds, well, that probably might make the bond market less than happy, and investors around the world may demand higher bond yields to compensate for the fact that just more paper, for lack of a technical term, is coming to the market. So we're creating more bonds, we're creating more dollars. You create something, more of something, it probably goes down in value. So the dollar is already weakened relative to a basket of global currencies by about 10 or 11% year to date.
Yeah.
Bond yields are kind of flat to down a little bit, but they're still pretty high relative to the rest of the world. And so the macro concern is, we're just continuing to live beyond our means. We're going to continue to create debt and bills and notes and bonds and dollars out of thin air. At a certain point, global investors are just going to balk at some of that, if not most of it, and demand higher yields, which means higher interest rates. And printing all that money could also be inflationary because you're just creating money out of, which is what we do, and we always do, is kind of create money out of thin air at a time when you've got the potential for tariffs to also drive up prices, even if that's kind of a one-time hit to imported goods and the like. So that's the more pessimistic take on things, that we're kind of getting to this point of unsustainability in terms of our fiscal, our health.
Yeah, and if we can't, that's that tipping point, right? If
Yeah.
we can't pay our own bills,
Yeah.
right? As a country, we have to file bankruptcy, so to speak, because
Yeah.
can't pay the interest of,
So
let alone the payments.
yeah, and so sort of the other side of that is, well, the U.S. Prints the dollar. And if we borrow in our own currency, we can never default because we can just create more of the currency. So they're in theory, which makes perfect economic sense. The U.S. never has to default because the U.S. is borrowing in the currency it creates. So you could argue that you could kind of just live beyond your means forever, but obviously there are implications in terms of inflation and interest rates and yields. We've got problems for sure as a country, structurally, financially. I would still take the hand we've been dealt relative to any emerging or developed country on the planet. And even if folks wanted to say move away from the U.S. dollar and kind of do business in another global currency, nothing really exists that could take the dollar's place. And if you think about the U.S. bond market, it's the largest, most liquid in the world. As a source of capital, as a place to put capital, nothing compares to it on the planet. So we do probably have to make some tough choices at a certain point in time around how we tax and how we spend. I just don't think that point in time is today. But at some point, the proverbial bill will come due, but I just don't think it's going to be now.
So overall, I'm going to put you on the spot, and this is what we'll close with. More optimistic or more pessimistic?
I think if you're thinking the next 12 months or so, and we try and think about the world in kind of 12 to 18 month increments because we don't want to be too short term in our thinking. You kind of get whipped around by the good news or the bad news. We're prone to sort of making bad decisions from a behavioral point of view, which you know really well. And I think if you go out too long term, it's just kind of it's not really helpful either. So we're halfway through the year. U.S. equities are up 6-7%, which is pretty remarkable considering all the uncertainty around trade and geopolitical risk as well. You've got the One Big Beautiful Bill Act signed into law. By most accounts, it's going to juice GDP by a full percentage point next year. And you've gotten some good news on the trade end of things as well. So I have a hard time now, especially with the legislation being passed and signed, seeing the economy really stumble into year end or into 2026. I just think the legislation and it's sort of the good stuff is at the front end. You know, the kind of spending cuts and some of the other things are at the back end. Given where earnings have been, given where the private sector is in terms of balance sheets and profitability, given the legislation, like it or dislike it, and the certainty it creates, I just, have a hard time seeing the U.S. economy not doing well over the next year or so.
Well, I like that answer.
Yeah.
And I hope you're right. I'm going to write this down.
Me too.
I'm going to come back to you in 12 to 18 months and figure that out. There's a lot there, right?
Yeah.
And some of this stuff, when you're talking policy, when you're talking a bill, it can be pretty dry and it can be kind of boring, but at the end of the day, it does affect most people. And I would argue that if you're a family we work with, or you're listening to this podcast, you're probably one of those people this does affect. And some of you in a very major way. And so it's just important to kind of talk about it. I'll triple down on what I said before. We're all over it. We know what's in the bill now. We're already making some changes in the way that we're thinking about things and modeling things out. And at the end of the day, there's just a lot of things we cannot control, right? And so one of the scariest places to be, Tim, is just always in that position of, I just don't know what's going to happen. And so how do I make decisions that put my family in a great place so that because I don't know, no matter what happens, when the big bad wolf comes, or if everything is, rainbows and butterflies, that in both scenarios, my family's going to be just fine. And that's the art of financial planning, right? And so that's where this kind of stuff comes in. And so every now and again, we got to get down into the weeds on something like the One Big Beautiful Bill Act. But make no mistake, this, along with every other set of facts and circumstances in your life, is just one of the small things that we have to keep in mind. And what we do with the debt, how the debt plays out, like, you can always point to three things, Tim, in our economy that would tell you that things are going to fall apart. And you can always point to three things in our economy that would tell you that everything's going to be amazing. But at the end of the day, we just have no idea. So I feel pretty optimistic as well. That is definitely not a political statement, so don't take that way. But I do think we have more tailwinds right now than headwinds. And hopefully that's exactly how it plays out. So Tim, I greatly appreciate your time as always. Always look forward to the monthly market commentaries when we do those. And so just a very special treat to have you in for a podcast episode. So thanks for joining us.
No, this was a lot of fun. I appreciate the invite.
Absolutely. And listeners, thanks for joining us for another episode of Retirement Redefined. Again, I'm your host, Brad Gatto, here with my special guest, Tim Holland, today. If you've not yet liked, subscribed, or done whatever these kids talk about with their videos online, I'm kind of old in this way. Like, you can follow us.
I can't help you.
I just know that you can push a button that gives you the notifications that every time we release a new episode, you're going to be notified so that you can come and listen to the episode. So whatever that is, and however you click those buttons, you should probably do that. Feel free to tell your friends about it. And we'll see all of you in a couple of weeks.
Thank you for listening. Don't forget to click the subscribe button. Thank you for listening. Don't forget to click the subscribe button. Be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views and opinions of Fiat Wealth Management. Content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.